Welcome to the first episode of Piedmont Connection. I'm Ian Asvakovith, and I'm joined by the two accomplished thought leaders who will share their perspective on the current pandemic. As many of you are viewing this program from the comfort of your home offices, we are now approaching 5 million confirmed coronavirus cases worldwide. Here in the United States, we have nearly 1.6 million cases and roughly 100,000 COVID-19 related deaths. The coronavirus pandemic has a profound and pervasive impact on the world economies. Total unemployment in the United States to date is nearly 37 million, or roughly 14.7%, the highest level since the Bureau of Labor Statistics began tracking this data in 1948. Yet the S&P 500 and Dow Jones Industrial Average has a strong rebound from the low. And now some might even say it feels like this pandemic will soon be over. But are we really out of the woods already? To help us make a better sense of the current pandemic and examine the new norm of our industry, I'm delighted to be joined by two guests who are knowledgeable experts in this subject matter. Our first guest today is Mr. Noel Kullavanijaya. Noel is the principal and president of capital markets at Equilibrium Capital. Equilibrium is an investment management company that focuses on sustainability drive real asset strategies. Noel is also CEO of Equilibrium Capital Services, the firm's broker-dealer subsidiary. Noel oversees Equilibrium Investor Network strategic activities. He was an investment banker for over 22 years on Wall Street with Merrill Lynch, Goldman Sachs, and Salomon Smith Barney, where he focuses on financial services and financial technology for US and international clients in Asia, Europe, and Middle East. He's a director on Equilibrium's board and also serves on various other boards in US and Asia. He holds degrees in mechanical engineering and MBA from Northwestern University. And like myself, he is originally from Thailand, so by default, he should be a Thai foods culinary expert. We also have Mr. Nicholas Sargen. Nick is an international economist who later became a global money manager. He began his career with the US Treasury and Federal Reserve. Nick worked on Wall Street for over 25 years, holding senior positions with Morgan Guaranty Trust, Salomon Brothers, Prudential Insurance, and JP Morgan. Nick was the Chief Investment Officer at Western and Southern Financial Group and Fort Washington Investment Advisor in Cincinnati, Ohio. He is affiliated with the Mayo Center for Investment Management, Darden Business School at the University of Virginia. Nick received his PhD in economics from Stanford University, and he's also the author of the book titled Global Shocks, an investment guide for turbulent markets, which should be a great read for anyone who is trying to make sense of the current market. I am fortunate to have a privilege of counting both Noel and Nick as good friends of our firm. Gentlemen, welcome to the program.
Thank you.
Thank you.
Before we discuss what the future of the asset management industry might look like, it is important to look back at the past crises and see what lesson we can draw from history. If we look back to the previous crises that created a systematic shockwave across the entire ecosystem, whether it's a savings and loan crisis of the late 80s, the Asian financial crisis of the 90s, the dot-com bubble of the early 2000s, or perhaps the Great Recession of the 2008, how does the current corona pandemic crisis compare to these game-changing crises of the past? Nick, let me begin with you.
Okay, Ian, thank you. The way I'd answer it is that I studied in my book, Global Shocks, really a series of crises going back to the breakdown of the Bretton Woods fixed exchange rate system. So that's 50 years ago. And what they all had in common was, I would say in general, they were man-made problems. In other words, typically what would happen is there were either policy mistakes, for example, the Federal Reserve or other central banks in the 70s and 80s were too easy, and that created inflation, and then they have to fight inflation, and that was the basis for, say, the developing country debt crisis or the savings and loan crisis that you allude to. In other instances, the mistakes were made by the private sector, especially financial institutions. And we all know, going back to 2008, the problems with some prime mortgages, and then financial institutions being overexposed to illiquid derivative instruments. So that was the origins. The difference that I see with the pandemic is it's not human-made. It's a natural, it's a form of a natural disaster or a pandemic. And so what the challenges are, because I thought I had seen it all and tried to fit these shocks into different categories, but this one is in a category by itself. And I would say, here I am, an economist, and normally I think my economic tools can help assess a problem. But today, I'm not an epidemiologist, and almost everybody would emphasize that the source of the problem was the pandemic, and part of the solution is how we deal with the pandemic. And yet, we have to rely on experts to guide us. So that's one difference. I think that the second defining characteristic of this crisis is that once the pandemic spread, the only way to mitigate its impact was through quarantining, shutdowning of businesses, or social distancing. And we've never seen this before. And so what it did is overnight, significant portions of the US economy were just literally shut down. And of course, this had spillovers. I would say most recessions affect interest rate or cyclically sensitive sectors. I'd go always housing, autos, banking, maybe manufacturing. This one, for the first time, really hit the service sector of the economy, which has usually been the steady Eddie. And it's, therefore, also impacted smaller businesses, and we can come back to that later. The last point I'd make is truly a global phenomena. In previous crises, there were times where the crisis would move around the globe, but it was often sequentially. I'm thinking, Ian, of the Asia crisis of 1997, 1998. It starts off where you're part of the world in Noel's, Southeast Asia, but it spread over time, and a year later basically hits the US economy when long-term capital management went belly up. So it moved over time. The difference today is virtually every major economy in the world and many emerging economies are feeling it at exactly the same time. And that's why, some have said, gee, this is the worst since the 1930s. I would just conclude, and we can come back to it later, it's not as bad. We're not going into a great recession. But when they look at unemployment rates and the speed of the decline, that's what they're alluding to. So I'll stop there.
Yeah, thanks, Nick. How about Noel? Noel, you've been in the business for a long time. How does the current pandemic and crises compare to the one in the past, and from your perspective?
Well, it's good you use the phrase pandemic, because often in the world of money, we look at it as crisis and economic shocks and so on. There are two things that are quite different here. One is that the crisis tends to have a beginning, a fairly identifiable end. This is not so much a beginning and end, but a change. There's a sudden shock that's happened, but the resulting changes leads to the second point, which is the duration of this. This is not something that will have a clear, okay, it's over, everybody get back to business as normal, because we expect that business will not be as normal as it had been, or the normal will change. It's interesting you use the word pandemic, because we are looking at this more comparably to what happened at SARS, what happened with MERS, which is the more recent 2012 Middle East respiratory syndrome. But in both cases, behaviors change. And this one, behavior is changing to the next point worldwide and much more pervasively. And that really is going to define how business is going to be done going forward from our point of view.
Got it. Well, let's examine the state of current pandemic a bit more. There's a debate today about the speed of recovery and how long it might take before we get back to the quote unquote normal again. Some economists are asserting that this crisis is just like any natural disaster, as Nick has mentioned before, and that we have experienced in the past, like a hurricane, for example. The initial event is very destructive, they say, but once the trickling event is over, we can go straight back to the rebuilding mode. In other words, the crisis will likely have a V-shaped recovery. Nick, do you agree with that assertion?
It's interesting, Ian, my view has actually changed. When we first got wind of this, and going to what Noel said, I mean, I had just left Wall Street to go to Cincinnati at Fort Washington in '03. And the first thing I had to deal with was SARS. And it was quite clear that it was very significant. But the question you had to raise was, well, okay, it may affect parts of Asia, but is it going to affect the United States? And we really didn't have much to go on. But the bottom line was the impact in the United States was fairly limited. And so we could go on with business as usual. So this time, when I hear about the coronavirus, my initial inclination is, oh, it's got to be like SARS. And again, I was telling friends, hey, a natural disaster hits a hurricane, it causes devastation for a quarter, but then once the hurricane passes, you do begin the reconstruction. And that's always the V-shaped pattern, meaning you go down fast, but you rebuild fast. And so for the reasons that, Noel and I have discussed, that's not the case today. The biggest difference I tell people is I know when a hurricane is gone. I don't know when this pandemic is gone, and we don't have a cure for it and everything. And so the key point is, yes, the market is optimistic because we're reopening businesses. But let me emphasize, this isn't you turn on the light switch and you're back to normal. I believe that the reopening is going to be very, very gradual, and it's going to differ across parts of the country. Those that have less density maybe can get back to business as usual, but those with more density, a different story. So the one thing on the shape of the rebound, I believe that one of the sectors, again, that's hardest hit is small businesses. And they're 45, if you define them as self-employed or less than 100 employees, that's 45% of the workforce. So when you go and you say 36,000 people have just been thrown out of work, a lot of them are coming from that pool. So let's take the optimistic case first. What's the case that it's not going to be as dragged out? And the argument is that a lot of smaller firms were forced to shut down, let workers go. Then in the meantime, the government, through the CARES program, created the Paycheck Protection Program, PPP. What is it supposed to do? It's supposed to create incentives for businesses to call back their workers and say, hey, guess what? We're furloughing you. The government's going to provide you, subsidize us, and we'll take money out, bridge loans, but we won't have to repay that money. So one of the arguments then is that as fast as the unemployment rate rises, and by the way, even the Federal Reserve and Secretary of the Treasury have said, by the time the dust settles, either this month or next, the unemployment rate could be 25%. But then the argument is that once the PP money is fully dispersed, then businesses can retake these workers so that you're going to get a quick decline. Okay, that's the optimist case. The pessimist case is this is a new program modeled after what Germany's had for 100 years, and there's glitches in it. It's going to take a lot longer. And even with unemployment insurance up significantly, a lot of businesses are finding their workers say, hey, it makes more sense for me to stay home than to come back to the office. So my bottom line is, what do we mean by a V? To me, a V would say, I have a steep decline in the current quarter, followed by a steep recovery in the second half of the year. And by the end of this year, I should be back to square one. However, if I look at what many economists are forecasting it gets back to square one, but not till the end of 2021. So you're 18 months away from getting back to square one. And again, the consensus view is that the unemployment rate will still be low double digits by the end of this year. So I do not call that a V-shaped recovery.
Mm-hmm. Mm-hmm. Yeah, yeah. Well, speaking of the government intervention, Noel, let me turn to you. In terms of the level of government intervention that are taking place through the stimulus program that Nick had just mentioned, whether it's SBA PPP program or other other stimulus as part of the CARES Act, by the way, not only in the United States, but throughout the world, is undoubtedly at the level that we haven't seen before. What are the short-term and long-term implications on asset prices and potential distortion in the capital markets that could result from this government intervention from your perspective?
That's the complex and this proverbial $60,000 question, right? In the near term, I think most economists will agree that we're looking at the GDP shrinkage worldwide. UN came out with something in the order of 5.8 or 6%, with a fairly robust, 3% negative worldwide, with a robust recovery in 2021, which I think is a very optimistic scenario. So the short answer is near-term contraction everywhere, unemployment spiking everywhere. The interesting question is, so what really happens in 21 and 22? With the amount of interventions, which is really going to depend on future proceeds that the governments have, tax receipts from growing economy, if that doesn't happen by 21 or 22, what happens to all this excess money supply, right? There is some concern among, I'm not an economist, I talk to CIOs, the concern among CIOs, what we speak to about the potential for acute inflation in about 2 years. That's a downside scenario they have to manage towards in case, right? Is that a 2 sigma situation or a 6 sigma situation in terms of scenarios they are predicting? The question of unemployment is also a very interesting one because to Nick's point, it is the service sector, it is the small business, the proprietorship. The optimists are saying the adaptability of that segment of the workforce and really business in general, the optimists would say they will come back quicker. The hard part is the interventions and also the scale of it all. It's not just the program that incentivizes people to perhaps think really hard about going back to work because unemployment is pretty good in some economies, but the scope of it all. When you're thinking about 30, 40 million Americans out of jobs, that's hard. And what is the absorption rate to bring all that productive labor back into the work stream? There's some optimists would say, well, technology will help that, and hopefully the governments will shift from stimulus as in handouts to more programmatic, longer-term stimuli, such as infrastructure spending. That's possible, but again, we're talking about scale of 30, 40 million Americans looking for jobs. And then the whole issues of demographic changes that come into play. Governor Powell said it's a W probably, because there's one big unknown here, is that we don't really understand, going back to your earlier question, we don't understand a pandemic well enough to know recurrence rate. What happens in the fall when the weather gets cold again? And as of today, there's a lot in the popular press about cyclical lockdown, cyclical shelter in place to protect the population and to manage against the load overburdening the hospital and healthcare systems. So what shape is it really, W or V? And really how long is the recovery going to take? Coming back to your question, I think near-term compression of the economies for sure. And the longer-term view is hard to predict beyond a year. Is the view that I'm hearing from many people I talk to.
Okay. Nick, what about the potential distortion of the capital markets? Do you have any view on that and how this government intervention could have an impact on that potential distortion?
Right. First, let me actually on the issue of distortions, let me start with monetary policy first, then work over to fiscal policy. So, Ian, when we went to go back to the 2008 global financial crisis, and basically, I believe the Fed was slow to understand the systemic risks until Lehman Brothers. But I will say, hats off to Ben Bernanke, who was a student of the Great Depression. And basically, he said, I'm not letting the US banking system go under on my watch. And so the Fed came up with all these unorthodox programs, certainly increasing the size of the balance sheet and then the range of areas that they would intervene in to support. And so the long story is he deserves credit to have saved the system, I believe. But honestly, the question that many of us were asking is, well, okay, it was pretty clear by 2011, 2012, we were through the worst and the system was stable. We were in recovery and everybody was waiting to get back to quote normal, meaning interest rates above zero. And, we had to wait until, ironically, about 2017, 2018, before the Fed first felt comfortable to raise interest rates again. Okay, so now we come to this crisis. And what they've done is taken out of the playbook from the global financial crisis and basically expanded on that. So for the first time, the Federal Reserve can now go out and buy corporate bonds. It used to just intervene at the short end of the Treasury curve, because the argument was you have to provide the liquidity to the financial system, but you don't want to distort it. You don't want to influence where the money goes. And now the Fed's whole mandate is if we see any illiquidity, any part of the bond market, we'll go there. And so, you're going to go into corporates. They even now have ventured into high yield, although it had to be investment grade before. So I just see, the intervention by the Fed as having broadened. And then the big unknown is if at some point the stock market were to retest the lows, which I think is a possibility if everybody's too optimistic, would the Fed at some point say, you know what, we'll follow the Japanese and even go out and buy equities? And so where I come out of all of this is I'm not critical of the Fed. I think, again, the mantra is we got to do whatever it takes to avoid a depression. I get that. But my concern is that we don't go back to a more neutral monetary policy once the crisis is passed. And in fact, I believe asymmetric behavior of the Fed, think of it, ever since Alan Greenspan created the Greenspan put. Stock market sells off 1987, massive intervention to stabilize the market. Market goes up to bubbles. Well, he worried about a bubble for a day in 1996, and then said, who am I to challenge the wisdom of the market? And so this is how you create asset bubbles, is through asymmetric behavior. Market sells off, you intervene, market goes higher, you sit on your hands until asset prices become distorted. So my argument then is the Fed is doing the right thing to save the system, but there are longer term consequences for capital market distortions, and I don't see a way out just yet.
Yeah, what that long-term implication would look like if, obviously something like government intervention can't sustain in the, forever. So what do you think might look like if the Fed's...
I would say, Ian, for that, let's go to Japan. I mean, Japan started this after the bursting of the Japanese bubble. And, you had the Japanese government intervening both through monetary policy and then also through fiscal stimulus. And what did it produce? Many would argue you contributed to zombie firms. Right? Remember, we're capitalists. And in capitalism, the system is supposed to allow inefficient firms to go out of existence. But if our approach is nobody can fail, then one of the consequences is that you foster inefficiencies. And in the case of the Japanese, they would build bridges to nowhere as public infrastructure. I honestly think in the case of the United States, we desperately need it. But I'm afraid that it's not going to happen. And that, the last point I would make is, what did this crisis expose? It exposed the weakness of the safety net in the US. In other words, we thought unemployment insurance would deal with the problem until it became so big. And that's why now we're considering furloughing, as the Germans do.
Yeah, certainly complicated issues. I mean, without the government intervention, Warren Buffett alluded to during his annual meeting this year, when the Dow Jones dropped from 240 in the August of 1930 to 41 or so in 1932, when it dropped nearly 90%. And it took almost over 20 years later until the market recovered. And that was because they didn't have FDIC in place to ensure the savers on their saving balances. So certainly you need the government intervention, but at some point, where do you balance? It's certainly a complicated issue. So,
speaking of the government intervention, we do have a quiz for the audience, and courtesy of Nick, Sargen. So here it is. What country is currently in recession today but report no net rise in their unemployment rate? Is it A, Japan, B, Germany, C, France, or D, South Korea? We'll let you take a guess, and we'll show the answer at the end of the program.
let me switch gear a bit to a more practical topic on the investing. Noel, as a long-term investor in real assets, how does the current crisis impact your investment selection or underwriting process? Has there been more investment opportunities because of the crisis, or do you see that yet, or how has that evolved within your perspective?
Well, I'll qualify my response by describing what we do, which is really long-term sustainability-driven type thinking. That sustainability is our thesis of our business, of our company. And in practical terms, sustainability means long-term. And if anything, we're beginning to hear, and we're reflecting what we hear from investors and LP investment partners that we work with, and the slow return to attention towards longer term is beginning again. There was a period of the last, everything is measured in weeks now. Over the last 9 weeks, has been very critical short-term attention to stuff, right? How do we remote work our people? How do we make sure people are in proper routine, have enough internet capacity at home? And in the last 2-3 weeks, how do we begin to adapt the resumption of business? What are the phases if you follow the different state governors' recommendation or guidelines or edicts? So those are near-term issues, but the few among the CIOs and portfolio managers we talk to have now come back to asking questions. So what is long-term reliable? What's long-term predictable? And that's becoming a little bit more topical in the last 2-3 weeks. And we like that, obviously, because that's what we do. In the near term, on a broader portfolio thinking, there are questions like, how much should we go to cash now? Should we go to more cash now? What is the denominator effect? And very interestingly, how do you plan for, I've used a phrase earlier, multi-sigma scenarios, right? Is it 2 or 5 do you plan for? Now, we've seen companies that are active traders just get crushed because their systems work exactly the way it's supposed to work. It just wasn't designed to deal with such big market moves in a day. And they're adjusting to that. But broadly, long-term thinking. Particularly if you're looking at investors that have long-term commitments to distribute capital, distribute pension checks, and so on. That's becoming a very critical issue. The near-term question: asset liability gaps widen among pension funds. How do you deal with that? So I'm raising more questions than answers, but I keep coming back to the phrase long-term because that's really what people are now searching for. Where can they put money that they don't have to worry for about 10 years, 15 years, 20 years? And that's, in the world we live in, that's pretty long-term.
Yep. Okay. So the way we've been interacting virtually for the past 8 to 9 weeks established a new norm for our industry. All of us are now dealing with our team member mainly through Microsoft Teams or Zoom or other similar technology platform. Could this work arrangement outlive the current crisis and permanently transform the way we interact in the future? In other words, will this digital transformation accelerate the trends toward attracting new talents across the different cities or even countries? And since we're no longer constrained by geography and limitation of our physical office location, how do you think this will impact the way we attracting new talents, or perhaps even move away from the physical location and transform more to the work from home more permanently?
Right.
Maybe I'll begin with you, Noel.
So what are some of the operating norms for the rest of the year? Let's start there, right? We're likely to travel less. Still concerned about getting sick on the plane. We're likely to have less ability to interact face-to-face. A number of institutions have already declared they're not traveling the rest of the year, and they don't want meetings with people traveling to them the rest of the year. So that's becoming, that has become, and I think increasingly will remain the operating norm, at least for the balance of 2020. Still, investments need to be made. So definitely greater use of technology, and actually much more sophisticated use of technology to travel less and meet more. When one makes an investment commitment as a PM or as a CIO, it's built on both credibility and trust, right? How do you establish trust in a world where you can't actually handshake, or have a face-to-face meeting live? It is sessions like this that will have to come into play. We are looking at ourselves, as well as some of our peers, really re-engineering the various processes of doing business. Think about the linear process of marketing and selling. You start with a meeting, you go with reviewing documents, and sometimes and then you meet. In our case, we actually have site visits because we have physical assets. We invest in greenhouses and water treatment facilities. And then you have closing process, which is documented. And then after that, there's the ongoing monitoring of all that. Which part of that work chain can be digitized in a way that that provides reasonable, if not even sometimes superior substitute to in-person meeting, more efficient certainly, right? Instead of taking 3 days to travel somewhere for a site visit, you can do it in 2 hours. Now, how do you do it in 2 hours? It is largely going to depend on the technologies of really giving the right context to any and all these interactions that are now online. Think about operational diligence. How do you do an operational diligence of somebody's back office without having to go there in person? And there's a whole bunch of work being done on that now on our part and on other people's part. The interesting thing too, I found is, a couple last couple of years, people have talked about, gee, why isn't online video conferencing more pervasive, and it will reduce travel costs and so on and so forth. Well, the shock of what's gone on the last 8 weeks have actually brought many of those things, those talked about, why don't we do this now, to the fore. We're doing it now. And video conference is just one. Some have even talked about other things like virtual reality in place of site visits. Now, how do you do that? And I think that that will be the norm for the balance of the year. How much of that will stay beyond this period? A fair bit, I would imagine. When you look at the economics of having to travel to meetings as opposed to think really carefully, not just the financial, but also the health costs of not traveling, it's pretty good. It will require some other developments in things like productivity measurements. How do you measure productivity of remote working of your workforce, right? And then other tools to keep your workforce in good health and spirits. Working at home gets you cabin fever. How do you provide not just productivity measurement, but also well-being measurements of your staff at home? That's also a new technology being developed around that. And all that is accelerating. We're seeing it happening now. Lots of experiments going on. It's definitely a learning process that we believe will stay.
So you and I, as well as Nick on this call, as well as all of our audience, we're fortunate to be in an industry that we can still work from home and still can stay productive and able to manage the things that we need to do. But what about some of the underlying businesses that you own that like agriculture farmland, the produce, the folks who need to be there, they can't really pick their fruits from working from home. How do you help those businesses and companies and people coping with the current pandemic?
Right. That's a great question. You know, it's just to put some real shape to it. In our firm, we have about 40 people, all remote working. And even this conversation is remote working. We indirectly work with almost 3,500 people who are on site, whether it's greenhouses or water plants. And they are mission critical people. They're producing food, they're cleaning waste, they're generating electricity. And they can't work from home. They have to be on site. So a whole set of interesting new protocols of workplace is now evolving. I wouldn't say we have all the answers, but there's a lot of experimentation going on, whether it's multiple shifts, backup teams. We put in residence technology, technicians so that we know where they are when we need them, as in bringing them into Airbnb and put them in place for a week or months at a time. So we know where they are, we know they're healthy. And the monitoring of all these folks, whether it's temperature testing or even broader health and well-being of their families, we need to be a little bit more pervasive. There's some challenging issues around that, privacy issues, information gathering in a reliable fashion so the data is good quality, analyzing the data in real time. Those are all things that are going on in administering and making sure that the on-site people who can't remote work, the essential workers, are staying in good shape and remain productive. It is quite a big change for them, to be sure. And we're still analyzing the cost economics of all that, how that is changing, how we have to do business. It will take it all the way down to margins of our produce that we sell. That's happening in real term.
Mm-hmm.
Much is talked about changes in the supply chain and how the logistics work around that. This goes not only to the workforce but also inventory. How do we make sure technology, which we had originally been sourcing overseas, not just our business but other people have been sourcing overseas, how much of the technology can be brought back or be sourced domestically of the same quality, of the same productivity. So those are all, you're catching this question right in the middle of the movie. Actually, I would say right at the beginning of the movie being made.
Yeah. Well, technology has been an important part of the remote work that's taking place during this crisis and the things that we've been doing lately. How has companies used technology in ways that we're not doing before? Maybe Noel, I'll turn you to this one. How has your company used technology today in the ways that you weren't doing before the pandemic?
I'll give you a specific example. I'll go back to what I talked about earlier in terms of changing processes and digitizing where we can, right? That's a very simple theme, but a complex one to do. We had a site visit that was scheduled for diligence. It was a visit to one of our greenhouse facilities, and pandemic came along. We had to change that into a virtual visit, an e-visit, if you will. It became an interesting collage. This is we're one of the first to have done that, for as far as I'm told, certainly by all the participants. It became an interesting collage of webinar and live streaming. And we learned in that exercise to intersperse graphic and live streaming, a little bit more sophisticated than FaceTime, but something along that line of walking around and narrating. And the challenge is keeping it real, because that's quite different when you're doing it as a substitute or as a surrogate for an in-person visit. That's a very different experience than watching a video late at night. Right? Watching a video late at night, you're looking for entertainment. You want some music. You probably are, at the end of the day, so you've set a finite time to watch. A site visit, so many different things happen when you go walking onto a visit. Somebody will step in a bucket unexpectedly, because that happens in real live person interaction. There's no scripting that will accommodate or allow for those unexpected things that happen. People shoot off in different tangent of questions off script. Just try that. So learning to do that, the technology around that really became a combination of better digital equipment, right? All the way to recording and replay in a way that's real time and live, that can accommodate 100 people at a time, 200 people, 500 people at a time, and that number is growing. And then to adapt all that into useful content, because we also want to have the ability for those who couldn't participate the first time in a site visit. How do we do an encore presentation of that? Those are all experience that, and if it gets into almost a production type thinking, how do you create a context of walking off the bus onto a site on a cold day in the winter, right? I mean, it's one thing to just have a picture of it. It's the whole experiential contexting of that. That's just a small piece of what we're doing to make the experience real. And the use of technology is pervasive throughout that entire process. I mentioned virtual reality. Is that the next best thing, the next thing we're going to do for some of our physical visits? A couple of basic things. We have to create trust. We have to create credibility. It's not so much create, convey all that. And that's really the challenge of how technology can enable us to do that. The other part, of course, is communication. The communication pattern that goes from cell phones to text to social media to regularly scheduled events like this, the composite of communication pattern now changes quite a bit. Each one of us now walks around with a laptop and a cell phone, but the cell phone is now basically a surrogate for a laptop. And how do you make use of all that, not just among ourselves, but now with our clients?
Yeah, one of the biggest surprise that I have during this pandemic is that how resilient technology has been and how we're able to scale with everyone working from home throughout the world. And there hasn't been too much of a glitch at all in terms of delivery and the reliability of the internet connectivity.
Well, somebody pointed out to me that had this event occurred 10 years ago, we'd be in a heap more trouble than we are today in terms of our businesses and frankly our economy. It still doesn't answer, though, the mission, to your earlier question, answer fully the mission critical folks who have to be on site every day. That to us is a evolving picture of solving that needs solving.
Well, we've been talking a lot about the current reality, the doom and gloom at the moment, but I want to end on a high note. I think Rahm Emanuel once said, "Never let a serious crisis go to waste." So I want to just pose the last question to you. What are the things that you're most optimistic about that might come out from this pandemic? Maybe I'll start with you, Nick.
Yeah, I was thinking about that, and I would say from the asset management perspective, you have to feel sorry for active managers. They faced an unprecedented bull market, 10 years without any downturn. And so what did that produce? That produced a lot of underperformance relative to an index. and contributed to a growth of passive relative to active management. Even if you're a hedge fund manager, tough to compete with a market that's going up and away. So if I was an active manager, I would say, all right, we've thrown you a lifeline. This market has been, pretty wild in terms of volatility, and there's been huge disparities. So you can't hide behind, that it's impossible to beat this steadily rising benchmark. So I think it gives active managers a chance to shine, which I hope they do. I think that would be a positive development. The second point I would make, and I came, in my book, I did a series of 10 shocks. And basically, the story with going simply is there's two periods. There's the 70s and the 80s. Those were high inflation period. During that period, there were a series of currency crises and the like. And actually, it was at Salomon Brothers at the time, and actually detected in a pattern of behavior. My beat was international bonds and currencies. And my colleague and I, John Lipsky, detected that there was a systematic pattern of the way in which the configuration of interest rates and exchange rates was changing. If you imagine a quadrant diagram, you were going clockwise around, and that was powerful. Well, as soon as I take my job to be managing money in the early 1990s, the pattern went away. And, I go, just my luck. And then I thought about it and think of it in a low inflation, low interest rate environment, which has really been the last 25 years. What do you produce? You don't have goods market inflation, you have asset bubbles. That was and Japan being the first example. So when I studied then a series of 5 asset bubbles, what is the conclusion? The conclusion is asset bubbles are tough because you can see them coming. I mean, I give you the example of the technology bubble in the second half of 1990s, and Robert Shiller, Nobel laureate, writes the book Irrational Exuberance. And I would say that was valid, but I truly believe at the time, I would challenge him and say, well, Professor Shiller, there are a lot of value managers out there thinking this is a bubble, and they're underweighting the high flyers. But guess what? You do that for 5 years running and you're out of business. So what do you do? In fact, there's a business school case study I love about Grantham Mayo and the challenges they face. So long story is, I think that in bubbles or the sell-off phase, that's the hardest phase. My argument is, don't fight the tape. Your job is to stay alive. You want to live to fight another battle. And really the argument that I made was you get a second chance, because usually markets overshoot to the downside. And then what you want to do is ride the wave back. And I would say, honestly, in 2009 and like, I gave us poor marks that we should have done a better job handling the down leg. So I'd give us a C-. But I will assure you, we nailed the up leg, and it lasted for a decade. So my view is, I still right now do not believe this market rally can be sustained. I just think it's happy days, and I just don't see it. I'm not a doom and gloomer, but I expect a retesting. But my point would be, I'm just trying to stay afloat right now. And then when assets sell off, you get opportunities. And my example right now is investment grade corporate bonds look attractive in terms of their spread. So at least, and our parent was an insurance company, so it was a bit of a windfall, because before you're going, the spreads aren't compensating me for the risk. Now they are. So my argument is, there's the down leg, stay alive, live to fight another battle, and then make your money on the turn.
All right, thank you for that.
How about you, Noel? If you can be optimistic, what can you be optimistic about?
Well, to which point, I'm happy to report glimmers of hope. What do I mean by that? What the pandemic has done in the immediate term is force us to think about the basics all over again. What are we eating? How are we spending time? Who do we spend time with, right? Quality time. How are we managing our affairs, our businesses, resources? You know, people are worried about toilet paper, water, right? Energy. Do we have energy? Do we have food? The basics are actually quite important to get right. And the optimist in me says that greater attention by the mass population, we're seeing a spike, and we're tracking, of course, produce consumption by the week because we make vegetables and fruits, and we're seeing spikes in all those direct channel consumptions. People are cooking at home more. People are paying attention to healthy food. Those basics, there's attention to basics of gives me hope, because it really also begin to extend to addressing long-term stuff again. We're starting to hear that, you know, from not just from people at home, but from people who manage money, from CIOs. And the long-term things about making sure we have the right kind of water, the right kind of food. Now, there's a lot of detail that it's really hard to get right. How do you change the supply chain of food in a way that is practical, right? It has implication on things like carbon footprint, and by extension, climate change. That's slowly coming back into attention again, and the shift in the last 9 or 10 weeks of paying attention to basics, to us, is a good foundation for paying attention to long-term stuff that need to be tended to in the first place. It won't be easy in the near term. To the next point, dislocation, lots of dislocation going on. But if we save a bit, and we're optimistic that if we save a little bit of ourselves to pay attention to basics and extend it to long-term needs, the optimist in me says there's hope that it'll be okay, but it's going to take some time, but it'll be okay.
All right, I think we'll end on that high note. And with that, I'd like to thank everyone for joining us today. Also, especially want to thank our guest speakers who are joining us for this engaging conversation, and also for putting on the jacket. This is my first time putting on jackets in about 9 weeks or so. So there's no doubt that this has been a transformative time for our industry. And I think we can all benefit from discussion like these as we navigate a way forward to a new normal and out of the crisis. Thanks so much, everybody. And the answer to the question that we posed to you earlier, which country is currently in a recession today, but reports no net rise in their unemployment rate, is Germany. If you guessed Germany, you got that right. Please come back and join us for our next webinar on June 12th, as we discuss the capital raising landscape for hedge funds during this pandemic. And now we can take a short break, and we'll return with a live Q&A session with the audience. Please use the Q&A function on the bottom of your screen on Zoom and type in your questions, and we'll address them for you.